There's been a bit of a global scare in the last 1 week, and the latest is China in that global growth slowdown scare. Chinese inflation numbers this morning have been a bit concerning. Jim Walker, Managing Director of Asianomics, who tracks the Chinese market closely and looks at India closely as well, joins us on the phone line. Jim, hi, good morning. We just spoke to you, less than a fortnight ago, and you have been quite bullish on India. But since then, things have changed a little bit for the worse. Would you be concerned about what's happening in China with respect to the growth slowdown?
Well, I think it's now very clear that the Chinese economy is certainly slowing pretty rapidly. It hasn't been reflected in its stock market because, of course, it has soared over the course of the last 6 weeks, but you can never really tell what's going on in China when markets are moving the way that they are. But I think that the real story is about the growth rate in China, and the outlook for that continues to be pretty negative into 2015.
Hi Jim, good morning and thank you very much for joining us. How would you read today's CPI numbers itself and PPI numbers, which are in year-on-year fall of 2.7%? Is this just a reflection of commodities, or is it reflecting a deeper problem in China?
Oh yeah, no, the PPI in China has been falling for most of the last 3 years. I think you would find that if you were to look at the series, that number has been negative year on year for really quite some time, around 30 odd months. So it's a reflection of what is part of the major problem in China, and that's the fact that they built far too much capacity in the industrial economy. And in order to get that capacity moving, they're having to cut prices. So there's huge oversupply in specific sectors in China. This is not really a reflection of the commodity price falls. It's a much more structural malaise in the Chinese economy. And there's going to be further falls in producer prices in particular over the course of the next few years.
Okay. Jim, for equity or risk investors all across the world, what is the biggest worry? Is it China or is it Europe? And is it a big worry at all, or will risk assets continue to be the best asset class as they have been in 2014?
Yeah, I mean, I think there are quite a few worries out there. I think Japan is a massive concern because of what they've been doing with debasing their currency and effectively letting the yen fall. Europe obviously isn't growing. It's got a long way to go in terms of working through the deflationary process, which is what they've imposed on themselves, of the southern part of Europe having to try and move towards a more competitive position with Germany. And of course the China slowdown is concerning as well. But I think sometimes we overlook the United States, and bear in mind that what's going on there just now is really quite concerning too, because one of the key elements in the growth story in the US has been shale oil. And with oil prices where they are just now, that part of the growth story is going to come undone. And if we look at what's happened with high yield energy debt in the last few weeks, it really does look like another significant problem for the US banking system. So there's a few problems all over the place, which leaves us still looking very positively at India, because I think India cleared out most of its problems over the last 2 years.
One more reason why the markets are getting a little spooked, Jim, is the fact that Chinese policymakers will be meeting this week itself to decide the GDP targets for the next year. And there are some estimates that it could come in at 7%, which will be the lowest in a decade for China. What are you forecasting in terms of what the GDP target could be for the next year, and how much of a slowdown we should brace ourselves for?
Yeah, their targets and the numbers that they mention are very different from the real growth in the Chinese economy. Our estimate at the moment is that China is growing probably somewhere in the region of 5 to 6%. Certainly nowhere close to the 7.3 that they report. And their view for next year is that it will move into the 3 to 5 range, because this is a significant shakeout that's required in the industrial economy in China. The thing that still remains very positive in China is the services sector, which seems to be doing really quite well. But industrial China and the property sector basically in recession.
Okay. So commodities bear market continues in 2015. Does it bottom out at all?
No, we don't think so. We've just put commodities onto our high conviction global short list. Even given the movement in the prices over the course of the last few months, we think there's very significant downside, at least another 25% downside to commodity prices.
That's a very important point you made, Jim. The fact that, the Chinese market could slow down to 3 to 4% growth in 2015. How much of an impact could that have on some of the Indian companies that have exposure to China? So, whether it's commodities, whether it's some of these auto companies, do you recommend that investors stay away from some of them now?
Yes, I think any companies which are associated with China growth at the moment, and most of them tend to be associated with growth in the luxury goods sectors or industrial equipment, earth-moving equipment and commodities. We have certainly recommended to our clients that they should be cutting back in those positions and waiting to see just how deep the Chinese slowdown really does become. It's certainly not over yet. That's the really key thing to be aware of. China has further to slow down, and that's bad news for the people who are selling into it. One of the figures that came out this week that caused some real consternation was the fact that imports to China were down 6% year on year. That's not just about commodity prices, that's all types of imports.
Okay, that's true. Well, finally, before we let you go, Jim, your thoughts on India. There have been some concerns that the government has not really moved fast in sectors like mining and power, in fact, generally on economic growth. Yet the Reserve Bank has promised a rate cut early next year. What's the India growth story? What is your take on Indian equity assets?
Yeah, we remain very positive about India. We continue to have along India as, again, one of our global high conviction calls. The business cycle is just at the sweet spot in India. It's beginning to turn up again. I don't think there's really any concerns now about the inflation outlook or the external balance outlook. And the central bank can get busy and start cutting interest rates, perhaps even as early as January. With the prospect of 100 to 150 basis point cut in interest rates through the course of 2015. We're really not that worried about the government's speed of doing things. I think the government is doing the right things steadily and slowly, and as long as that's the case, we'll be very happy, because it wouldn't really take very much government activity to get the Indian economy moving again.
Well, that's nice to hear. Jim Walker, pleasure speaking with you. Thank you very much for joining us.
Speak to you again. Bye for now.
Yes, we will. Thank you.